Hi, thanks for watching. My name is Paul Long. Today we're going to talk about guidelines for acquisition funding. You know, buying a business can be a lot of work, just like starting one, but it is nice to be able to purchase something that's already been established. I wanted to go over some of the funding guidelines that banks look for when doing that kind of financing. What's important to know is typically we look for 20% down when looking to purchase a business. This is usually in the form of cash. Typical seller financing is usually from 10 to 15% depending on the industry. So there's several different avenues to this. We want you to bring some money to the table, but we also want the seller to be able to carry a note themselves, and then a bank would finance the rest. What this does is protects the opportunity of where there's a business owner trying to sell a business that probably isn't doing so well to the next sucker. You don't want to be that guy. Bank loans then typically are anywhere from 65% to 70% of total costs. That's your selling price plus your working capital and fees and costs. What's important to understand about business acquisition financing are what are the financial trends of the business before you do the financing. If you have negative trends in your overall profitability or gross annual sales, that's going to be a hard business to finance. So if you did find a business that has increasing revenue or has stable revenue, then acquisition financing could be a great option. There's a few things to know also about acquisition financing when it comes to changing of ownership. There's a few very key important rules. One is, when you're purchasing a business, the existing owner must leave the company within 12 months. They can serve as a consultant, but at the end of the 12 months, they must leave the business completely. Also, SBA, which is usually the program to use for acquisition financing, will not finance a partial change of ownership. So let's say, for example, there's an attorney firm with 3 different owners, and you and I want to purchase another individual's part. We cannot use an SBA loan for that. So you may want to look at using personal resources, personal loans, home equity loans in order to finance that type of acquisition. Now, if you and I wanted to purchase the business together in entirety, then we can use acquisition funding to do so. Landlords of a business you're purchasing will need to sign off on what's called a landlord release form. This allows us as a bank to be able to take any sort of collateral that we may have on that type of loan. We usually like to start up with this type of form at the beginning of the process because sometimes the landlord does have questions on doing that. Requirements. All principals that have over 20% ownership must guarantee the loan. This is a very important piece. If the loan is not 100% secured by hard assets, that's real estate, fixtures, equipment, whatever the case is, then we may actually need to do a business valuation. So let's talk about business valuations. It's very important that you understand what the value is of the business you're purchasing. If you're truly doing a small business, under $150,000, a formal business evaluation is not required. However, anything over $150,000, we will need to get a third-party valuation company to take a look at the business and give a value. Just so you know, those run anywhere from $3,000 to $5,000. Other things we're going to look for. Principals must be active owner-managers within the business. We're not looking for passive investors. Principals must have a significant related industry ownership and really understand the industry and the business that they're doing. Principals must have good credit history. Most banks like to see 700 plus with no bankruptcies in the last 7 years, judgments, defaults, or any sort of things that may disqualify you for the loan. Principals, at a minimum, must be a U.S. citizen or resident alien with a green card. Again, we talked about earlier that banks typically do require 20% equity down on this type of transaction. And they also do like to have an additional seller carryback in order to make a nicer cushion for the bank. If the purchase price of the business includes $500,000 or more of what's called intangibles, that's anything from goodwill, patents, do not competes, trade names, customer lists, the bank may require that there must be at least 25% seller equity, which is that seller carryback note, to be a part of the transaction. So I gave you a lot of information there regarding acquisitions, and that's just the tip of the iceberg. So it's really important to talk to your trusted business lender about these types of acquisitions. Feel free to check out additional information here on my site at paultlong.com, or feel free to reach out to me or contact your local SCORE chapter, your local small business development chapter for additional resources and tips and guidance. Thanks so much for watching.